Hi, everybody. This is Rich. Just wanted to touch base on two topics that we didn't cover in class, just as we dedicate a little bit more time to in-class exercises. But I still want everyone to be familiar with the content, and you're accountable for the content. Um, so this is primarily a familiarization with the EVA approach to evaluating an investment center performance. So recall from class that there's three ways to evaluate investment center performance. There's the ROI method, there's the residual method, residual income method that is, and then the third one is economic value added method. So the first two is what I place the most emphasis on. I think those are the most straightforward, I think perhaps the most practical, relatively commonly used. But I wanted to touch on the EVA approach because frankly, this is one that I've seen used in quote-unquote real life. At my most previous external employer, we used this approach for many years, not without its pros and cons. But I thought to myself, you at very least need some exposure to this concept in case you work at an employer where they utilize this concept or they take it into consideration. So let's just talk about what it is and how its components are, and this will be really brief. Again, the purpose of economic value add, it's similar to what ROI and the residual method intends to do. It's just how much, it's a measure of how much shareholder wealth is being created. So as you're analyzing investment opportunities, do you open a new plant? Do you create a new production line? Do you expand your product line to include new flavors if you're an ice cream maker, things like that? This is a way to measure the wealth that you intend to create with that investment. So let's look at kind of the mechanics of how this calculation comes together. So to begin, excuse me, the investment center's after-tax operating income is our starting point, and we deduct from that an investment charge. And that helps you quantify in dollars the amount of economic value add. So that's the ultimate goal, but there's two steps that precede this. So the first, you have to calculate what is this investment charge. All right. So to calculate the investment charge, you would take investment center's total assets minus investment center's current liabilities, and that would give you a working capital number or a net assets number. And then you would take that net asset. So this is like the net assets of your business. These are all your income producing assets. So remember, the textbook definition of an asset from your 201 class, it's a resource to the entity. It has future economic benefit to the entity. So we're trying to get to, hey, what is a future economic benefit on these assets? So anyway, you take those net assets and you multiply it by a metric we call weighted average cost of capital. So if you think back to 201, the resource of an entity, the assets of an entity, are financed by a combination of debt and equity. That always holds true. It's the old accounting equation. Assets equal liabilities plus stockholders' equity. So this basically says for the net assets that you have, your income producing assets, what is the associated cost of that? So the step that precedes this step is that you have to calculate what is weighted average cost of capital. So weighted average cost of capital can be calculated in a number of ways. But real simplistically, if you just ignore these formulas and think at a very high level, there's a cost associated with every dollar of debt that a company has. So that might be just their interest cost. So when I did a weighted average cost of capital analysis of my previous employers, it would often involve just understanding, hey, how much does it cost for us to borrow? And to figure that out, I might just go to the notes of our financial statements. And if we had a debt instrument or if we had a revolving credit facility that charged X% on an annual basis, I might use that as my cost of debt. Cost of equity, it's a little bit trickier, but the concept is still the same. You may not pay interest on your equity, but there is an expectation of investors that they will get a minimum, a basic fundamental rate of return from their equity investment. So if they contribute $100 in equity to a company, they might expect $10 of income from that investment each year. And that $10 might come in the form of $8 of dividends and $2 of stock appreciation. And by stock appreciation, I mean the stock price goes up in value on the open market. So in that case, if they have a 100% investment or $100 investment and 10% and a $10 return, that's a 10% return in the form of a combination of market appreciation and dividends. So that would be your cost of equity. So the weighted average of these two is basically takes into account the variability between your capital composition, whether the right side of your balance sheet is skewed towards debt or equity, which may vary depending on points in the year if you're a cyclical business. But anyway, these are the components of the weighted average cost of capital. The weighted average cost of capital factors into your investment charge calculation. Your investment charge calculation factors into your calculation of economic value add. So again, this information is intended to just kind of broaden your horizons. I would expect you to know that there's 3 approaches to measuring investment center performance. Although we've emphasized the ROI and RI methods, awareness and understanding of this approach conceptually is certainly my expectation. Thanks, and if you have any questions on this video, let me know.